Money, school, TV.
So what I'm going to start with today is I'll do a really quick, brief overview. For anyone who hasn't attended previously, this is week 4 for me. In the first week, I talked about audits. And the second week, I talked about the legal representation inside the four walls of an insurance company. And then last week, I talked about premium writing controls. And today, I wanted to talk about something called rating agencies. And many of these rating agencies you guys have heard of before. I'm going to call them Who Watches the Watchmen, and it's these rating agencies. And I've got a really good story I'm going to share related to this that I experienced firsthand. And the thing that's interesting about these rating agencies, there are 4 of them. One is called Ambest, and that's the one that is kind of our holy grail inside the insurance industry. They specialize in insurance, but there's also some things that you guys have probably heard of before too. S&P, Moody's, Fitch. You've heard of all those organizations. Do we, as insurance companies, when I worked in the industry, preparing the statements, did we report to those? Yes. But the number one guy that we always had to have on our side was Ambest. And I thought it's really kind of interesting that we would be almost fearful of Ambest. You wanted to be in good graces with them or following what they needed because they could cause you some problems. And it's been interesting for me as I dug into this a little bit more. Like I said, this turned into 22 pages, so I might have to have part 2. But what I always was curious about, even as an employee, is why do they have so much control? Because Ambest, for those of you that know or don't know, Ambest gives a grade to an insurance company: A++, A+, A minus, A minus minus, B+. Now, that might sound really funny that you got all these ranges of A's. Well, there's a reason. And the reason is, as an insurance company, if you don't write on A paper, you're a failure in a lot of ways. Not that you can't write business, but it will cost you business, and it will cost you big business. And I'll explain that later because I actually worked for a company that got dropped from A paper, and it turned into a scurry to try to manage it. They did eventually get through it, but I'll tell you what happened. And it was difficult. It was scary. It was strange that they were not statutory or regulatory, and they had that much control just by giving us a B plus rating as an insurance company. So I dug into this to kind of give you a little bit more of an understanding of it, because this is another layer of protection for everybody. And I talked about audits. You have outside audit firms, you have outside actuarial firms, you have outside people reviewing your investments. All of that is filed with the National Association of Insurance Commissioners, NAIC, we always call it. All of that goes to state regulatory boards. If the state regulatory boards and the NAIC think your ratios don't fit their norm, they'll come in and take over, which I talked about a case where, yep, I experienced it firsthand in week 1. This time I'm going to tell you about an Ambest rating that created an interesting time for me in my career. And I'm going to start with the idea that that as an insurance policy, you're placing your money, your savings with a company, and you're hoping that financially they're going to be sound so that, say, 40, 50, 60 years from now, you may not be here, but you want to have confidence that your family is going to receive a payment on behalf of you when you're no longer here. So you're putting a big trust in an insurance company, and make no mistake, that trust has not been taken lightly in this industry, at least in my opinion, based on the amount of control that I've seen placed over the top of insurance companies. So I want to kind of talk about, why is Ambest important, since we already have all of these regulatory boards that are standing over the top of us, that are asking us for ratios, that are making us explain ourselves, auditors asking us to say, are you related to anybody in the company? They can't report to you. Has your main managing auditor been on the account for more than 5 years? He can't be. Get him off the account. There are so many things into play before we even get to this point. Why do I care about the Ambest? They look at a lot of the same things, but they look at it differently. And that little A paper I told you about, it's got a lot of magic behind it. Regulators are government oversight. So regulators are the NAIC in your states where your insurance companies do business with. They enforce solvency laws. They ensure compliance and legal safety. They protect the system. They review things. They do not issue grades. They don't care about grades. That's AM Best. They don't care about that. All they care about is you're fitting in their little boxes. And if you're not, they're going to come in and take over. Now, when you go to the AM Best or these rating agencies, they're private, they're independent, they're not regulatory, they're not state owned, they're independent, private. I almost feel like, and maybe this is the wrong thing to do, but I almost feel like they're like the Better Business Bureau on steroids, because they can create change in an insurance company. And I'll explain that shortly. They're private, they're independent. They rate beyond minimums and they look for excellence. I almost think they're also, in a way, in the corporate world, you have things called the best and brightest companies. So they send out questionnaires. They ask your employees. They look at your premium rating. They look at your retention rates. They look at all this stuff and they decide they're going to give you a grade. But again, they're private. They cannot come in and take over like the state regulatory board can. They cannot come in and say, you want to sell your company? I don't think this price is right. You can't do it. They have no control. They're private, but they're still reporting. So they are quicker to react. And I'll tell you what I think happened in the case where they caused us some problems. And it goes back to the 2008 thing. So I'll kind of explain that a little bit. I could be off a little bit on what I'm remembering, but it'll give you an idea of why these rating agencies are really important. And I'll tell you a story about my mom. She loves knowing this now. But they serve the consumer. They're all about the consumer. And they publish comparatives of insurance companies. But again, AM Best is the top one for the insurance industry, and all insurance companies that want to make it in this industry better be writing A paper, because A paper is highly sought after. And if you do not keep A paper, you'll lose business, which is what experience that I had during my career. So it's a check and balance. It gives the public transparency. It's a speed. And I think, and I'll share this now, what I think happened in the company that I worked for, we went through a period of time when 2008 hit that mortgage-backed securities were in question because of everything you all know from listening to Chris. Well, what happened in our industry is, because we are so predominant on bonds and mortgage-backed securities, the NAIC, the National Association of Insurance Commissioners, and the state, it was them that actually ruled it, but it was adhered to by the states. At the very last minute, when a lot of stuff was going on and we were filing annual reports, they came down with a ruling that was a new additional reserve we had to put on our books to protect our insureds because of all the uncertainty around the 2008, the mortgage-backed securities, all that stuff that was going down. They came up with this brand new reserve, and it was called OTTI, other than temporary impairment. So all of us in the insurance industry had to stop everything we were doing. We were like at the 9th hour getting ready to file statements, and we had to redo all of our statements. We had to bring in this new reserve. So it wasn't like a claim reserve. It was like an investment type reserve. It was a reserve for kind of bad debt, for lack of a better word. It was this reserve like, we don't know what's going to happen. We need to protect our policyholders. We need this reserve. You put it on your statements or we're not accepting them. So we literally worked 24 hours a day for about 2 weeks before that first March 1st filing deadline, redoing all 140-page legal page documents of these insurance companies to put them through to the NAIC. But I think what happened in doing that is that some of these insurance companies that were maybe on the edge of, say, A- paper, and we were A- paper at that time, got dumped down to, say, B+ paper. And when you got dumped to a B+ paper, there are many people in our industry that will not write with a B company. And it's kind of unusual when you think about it, because a B is okay if you're a college student or even a doctor. You no one ever asks your doctor for that, for your score, or very rare. I don't know many that do, but they don't ask for that score. But if you write anything less than A paper in the insurance industry, it's a big deal. The average consumer probably doesn't know. Now, my mom, she loves it. She goes, excuse me, that insurance company you want me to write with, what kind of grades do they have? And they're usually always surprised, but that's because of me. She knows that everybody else doesn't know that. But it's probably a good thing to know. And let me take a look. I actually looked up the ratings for the companies that we write our insurance policies with. And they, of course, were all A paper. They were actually A+ or A++ paper. All of them were A+, Security Mutual, Lafayette Life, One American, and I believe Mass Mutual was A++. So they were all in the A+ arena, which is what we all want. But the reason, like I said, and I wanted to look up and find out what they look at with the AMBES is they look at capital adequacy, reserves and surplus, investment portfolio, liquidity and reinsurance, and management and governance. They're looking at the same thing that a rating agency would, but they're looking at it from a different perspective. They're more like forward looking. And I think, like I said, in 2008, I think when they were forward looking, when this OTTI number came out, they started thinking that insurance companies might start to have some trouble. So they were downgrading people. And it was unfortunate if you were somebody like us, where you were at A minus, you were struggling a little bit because everybody started to struggle. Insurance companies write predominantly mortgage-backed securities, at least in my day, in their investment portfolio. So we were so heavy in that any OTTI impairment was going to impact us because we don't invest. They do not invest like somebody goes out and tries to get rich quick in the stocks. They don't do the calls and puts. They do long-term investments in bonds, and that's what they write their investments predominantly in. And that's because it's considered to be safe and secure. And I think within the next 2 weeks, I'll talk about something called SVO, or Security Valuation Office. They actually take the investments and they rate them 1 to 5 and put them through another set of review and advise that they agree or disagree with the way the investments are invested. But I won't do that today because that's how I got to 22 pages. So I know I can't cover that today. But the idea is that there's so many hands over the top of it that there's safety for you. And the one thing that kind of hit me and why this was important to me is an AM Best rating on a paper. I thought, we've got so many hands over the top of us. We've got the board that is over the top of the company. You've got the inside auditors, the outside auditors. You've got the NAIC. You've got your state regulatory boards. Then the regular people that everybody has, the IRS, the property tax audits. There's audits everywhere. So I'm like, this AMBES, how much control can they have? Well, let me tell you, they got a lot of control. When I was working in the insurance industry, and this was actually the publicly traded company. It was actually publicly traded because for a brief period of time, I worked publicly traded. And what happened is we were A minus paper, and we started to get word because you always know ahead of time. In insurance, there's no surprises. Somebody's telling you your ratios didn't come up. Let's send some questionnaires. Let's do some follow-up. If this doesn't come out the way we want, we're going to downgrade you. And so, a couple of weeks ahead of time. When the company that I used to work for in very early days of my career was in jeopardy of being taken over by the regulatory board, we knew a couple of weeks ahead of time. They were looking at a bad faith claim. They told us if this bad faith claim comes down, we're going to come in and take over unless the owner's willing to put in. In those days, it was probably $5 or $10 million. They wanted him to influx into the company. If he wasn't willing to, they were going to take over. Well, AMBES, we kind of knew. We knew that based on what had been going on with all this mortgage-backed security stuff, we knew that we could be downgraded. So there was talk, and what was ending up going on in the insurance industry is that two things had to happen. You don't know if AMBEST is going to get you back to A paper. So what are you going to do if they don't? So you got to be working over here to try to keep that A paper. But what are you going to do if you don't get that A paper? You got to figure out plan B, because we knew in the industry we were writing in that we couldn't maintain our book of business if we were anything but A paper. So what happened is we had this team trying to get AMBEST to keep us A, and we had this team getting plan B. Well, thank heaven, team B was working because AMBEST didn't back down. They put us as a B plus writer, and we started getting word that the business that we were doing was not going to stay with us. So they were over here negotiating. And for some of you, you might have to go back to a previous talk, but in the insurance industry, you can only write insurance based on if you have assets, meaning like your home, your investments, all of those assets, and you have liabilities, what you owe on your home, what you owe in loans, what you owe in credit cards. When you net those out, you have a surplus amount of money that's not spoken for. And as an insurance company, and I talked about this last week, as an insurance company, you can only write new premium $1 for $1, generally in a mutually owned. That's the general rule. But the actual rule, like with the NAIC for many states, is $3 of premium can be written for each $1 of money that you have that's not spoken for. So what ended up happening is we have this big, huge book of business. This is all of our business that we can't write because we don't have a paper anymore. And they had to go search for a company that would allow us to become a managing general agent, which means like I'm an agent, Jason Sipple, Craig Yanni, all of us that are agents are underneath an insurance company umbrella, meaning say Chris Noggle Insurance or the Money Multiplier Insurance Agency. We all work for an insurance agency. Well, when we lost that A paper, we had to become a managing general agency. So we have this book of business that we've built that is our book of business, that is everything we operate off of. How do we maintain it and keep it steady? Well, they had to go find a company that had enough available unused surplus to take on our business because we couldn't maintain it. And we had to find a company that had A paper. And we did find a company that had A paper. There's a couple of them out there that are really, really big companies. And we were able to negotiate over there. So what happened is everything that we always did stayed internal in the offices. We did everything like we always did. But then we got it to a journal entry format, sent it over to them because they had to book it on their books. And what ended up happening is we let them keep a percentage. I think it was about 5.5%. They got to keep 5 or 5.5% of this huge book of business so that it could be written on A paper. And that was their cost to let us use their surplus, so that we did everything we always did, but we had to give it to them to put on their financial statements, and we gave them a percentage, and we operated as a managing general agency. We had no other choice. Ambest, not regulatory, but they put that much pressure on us, and that's what we had to do because we didn't have A paper. Now, it took about 3 years of jumping through hoops and following what needed to be done. The interesting thing about all of that is we were never regulatory concerned. During all of that time, we were never being considered as a risk for regulatory oversight. We were never in trouble in that way. But the Ambest had the ability to put enough concern or public opinion that we had to take action. And I think that's what it is. It's a public opinion thing. If somebody, I think that's a lot of what we fight with when we're trying to make people understand. I think that's where we have a lot of issues when people are trying to write these insurance policies. You get public opinion and you get people speaking in your ear, and it causes you to second guess your decisions. Well, the Ambest coming down with a B rating can cause enough questions in policyholders or in agents' minds that you can't get the business anymore. So it took 3 years and giving up 5.5% of that entire book of business to rebuild until Ambest decided to give us A paper again, because it was made clear, because all these talks were going on. I think there were a few that allowed us to stay direct as B+ paper, but most all of our business, when they reached out and talked to them, they're like, nope, A paper, nope, A paper, nope, our board meetings, it's got to be A paper. So is there a lot of control over insurance companies? There absolutely is, because not only do you have regulatory control, you have these outside audits going on, you have actuarial reviews that are signed off and filed every year, you have Ambest who can out there influence public opinion, even if you're not being considered an issue regulatory control wise, they can still create public concern that can affect your business. So all the way around, there is so much control over an insurance company that I'll tell you, for the longest time, I was always trying to get out, because I felt like a lot of the events where I've met a lot of you guys, and I love meeting all of you, and I love sharing what I've learned, but I would never have been able to attend those events because as an insurance accountant, my life was owned by them from either December 1st or January 1st until June 1st. Because the way that all works is your first set of financials that are due to NAIC or regulatory boards are March 1st. They get those statements March 1st. They start pumping them through for what Chris calls key performance indicators. We have like IRIS ratios, risk-based capital ratios, stuff like that. They don't necessarily call them KPIs, but they're the exact same thing. So they start running them through in March, and they start identifying companies that they think have a need for regulatory concern or control or oversight. So they'll already start the lists between March and June 1st. By June 1st, your statements have got to have gone through a full-blown audit and an actuarial review and signed off statements from both of those terms, because once that's all finished, they'll start taking action against everybody. But all of that is that side. We have Ambest over here, who is controlling public opinion with A, B, and C paper. And it may just be that they're starting to see something change, but they did impact a company I worked for. And I will say this, because you may go down the same road I did. When this first happened, I felt like my company was cheating. I felt like, is this really right that we're doing everything we've always done and we're just paying them a percentage to write it on their name? Is that cheating? Because I kind of felt like that was cheating. And I had to sit down and reason out with myself, because if there's one thing about me, to the best of my ability, I'll be completely honest with you. And it didn't sit right with me at first until one day I sat down and I'm like, wait a minute, we just got a whole new set. We have to go through all the same auditing processes that we've always had to go through. At the same time, we're trying to recover our A paper and maintain that we have our regulatory standings with the state regulatory boards. So in essence, we had to pay a fee and we had to work harder to get back the money, because we had more people we had to answer to. Because not only did we have everybody we answered to before, but we had to answer for the audit questions that came up for the company that took over that business. So are they regulated? To a degree you would not believe, and to a degree that felt natural to me until I came out to the outside world. And I'm like, what do you mean you don't follow generally accepted accounting principles? What do you mean you know? And that's what's in the industry, where we have things called generally accepted accounting principles, and that's generally what an audited financial statement will be. And in an arena that I worked a lot in, we had stat rules, which were statutory accounting principles. So we had stat and GAAP. And that was because as an insurance company, we have to prepare two sets of financials. One as a going concern, meaning we try to match period for period. Are we profitable? And the other set that we file with the regulatory boards are statements that say, hey, if we close the doors today, will we be able to pay every possible claim out there from now till the end of time? And that's how controlled it is. But it just kind of blew me away that a rating agency that to me seems like Better Business Bureau on steroids could have enough control that a solid company in the eyes of the regulatory board could have to go through the hoops that we had to go through. I could get mad about it, but it's about protecting you and it's about protecting me. So, and it's what we all know. We in the industry, we know this. We know that this can happen and we know we have to take action, and the tools were there and we got through it. Was it pretty? Probably few sleepless nights, but we did what we needed to do and everybody was protected. Did it turn around? It did. And they actually said, as a company, we turned that around in 3 years and got back the A paper. And they said normally it takes 5 to 6 years to get that A paper back. Now, what I'm speaking from is older information. It may be different now because I haven't been intimately involved with that process in probably 5 years now, but or 3 to 5 years. But I just wanted to share with you guys the stability, because I'm confident in this industry. And I wanted you guys to be confident in it. I want to look for any comments or questions, and I'll save and I'll give you a little teaser. I did mention earlier something called the Security and Valuations Office. So on top of all these other things that they can check on you about, we have a whole series of ratios that we had to put together utilizing ratings. So we would take our investment schedule, and our investment schedules were hundreds and hundreds and hundreds and hundreds of investments. You would have to look them up. And then this group called the Security Valuations Office, or known as the SVO, would give them a rating 1 to 5. And you would have to run them through, because just because you had that asset and that investment that organization would say, do we think there's any chance that there could be a problem with this? How risky is it? 1 being great and 5 being bad investment. And I think anything under a 2, you are really, really discounted, or it would take a hit to surplus. And that's what happens is if they see things that they think are risky, you have to do what they call take a hit to surplus. Like in financial statements is a generally accepted accounting principle. If you have receivables, somebody hasn't paid their bills for 90 days, you have to take that as if it's a hit to that free surplus, because they have to assume that you're not going to collect it, which is why you start to see all these selling of mortgages and stuff, because companies have to non-admit that. And that is what we operate off of, is that money that's clear and good. So we don't like to take hits to that number. But I'll look for any comments or questions. I know I only have about 3 minutes left because I'm yuppie and I didn't get through all 22 pages. So we'll talk more about this later. But I just feel that this is so important to know. And I'm sharing with you firsthand experiences. I was there when our AM Best rating went to B-. I was there when we had to get the other company. I was there when we had to start reporting to them and answering to their people as well as our people. And I was also there when I saw that we got back that A paper and we internalized everything again. I am actually an agent, and Linus and I are actually working with clients now. So if you need to book a call and you want somebody to help you through the process, please use this link below, and Linus and I will take you start to finish. I do say it is comforting. You know, Shane, it really is comforting to me. And that's probably why this transition, I doubted the IBC part of it, but I never doubted the stability of an insurance company. I just had to overcome that. I had to overcome the IBC process. That's where I had the hang up. The stability of an insurance company never concerned me, but that IBC process. And then when I was able to dig into that and see that it was exactly what it claimed to be and so much more, I wish I'd known about it 20 years sooner. But the insurance company, I'm like, I in a way, I can't understand why anybody would put faith in a bank when an insurance company is held to a standard that banks are not held to. If you sat down and looked at what a bank goes through, I'm sure they go through rigorous audits, but they're not accountable dollar for dollar like we are, because we can't have this fiat money where you have $1 for every $10. We have none of that. It's dollar for dollar. If they think that we could potentially have $15 billion of potential claims, we better have enough in reserves to cover that $50 billion. There's no creative accounting in it. It's got to be dollar for dollar match. They don't play that game. It has to be that one day when your family member, because this is permanent, life insurance is permanent insurance. We're all going to die and somebody's going to collect that money. And they want to know that you're managing it. Because if you don't manage it, and I've mentioned this before, there are guarantee funds with each of the states, and they have to dip into those guarantee funds to pay those claims. And who do you think pays those guarantee funds? We do. When I was in the industry, we'd get a quarterly bill and it would actually list which insurance company got taken into receivership, because that's what will happen when an insurance company decides, oh, we're done playing with these people. Receivership, they come in and take over. And that's what happened to me. I got removed from that company and I worked for the state of Michigan under the receivership people. They'll come in and take over, and if they can't pay the claims, they'll actually go to that guarantee fund. But then once a month or a quarter, I can't remember exactly, they'll send you a bill saying, okay, this many companies, and there's usually only 1 to 3 at the most, because it goes years and years and years. A claim can take years to settle out. In the property and casualty industry, a liability claim has what they call a tail of 7 years. In the life insurance industry, you know, it can be 30, 40, 50, 60 years before a claim's paid. So if that's the case, if a company went into liquidation, they're going to have bills coming out for that company for up to 50 years saying, okay, we paid out this many on claims for this company that went into receivership and there weren't enough funds. Here's your percentage of the business. Here's what you owe us. And every quarter or every month, we would get those bills. And I think it depended on the state, whether it was quarterly or monthly. I am 1 minute past time, but I don't see anything, but please feel free. If you have a policy with an insurance company that loses its A paper to B paper, how does it affect the holder? Great question, Lisa. as an insurance company, the only thing that happened for those that we had to send off is the name at the top of the insurance policy changed. So say it was XYZ Insurance Company was your original insurer. When we issued insurance policies after that, it was ABC Insurance Company, but everything else operated exactly the same, including all the audits and the regulatory oversight. Everything else happened exactly the same. It's just that we had to basically kind of reinsure or go to somebody who had a paper and borrow their surplus, their funds that weren't spoken for, to write off of that until we could get back to a paper. So for you, the only way you would ever see it is that the name at the top may change. But as a caution, if a name changes at the top of an insurance policy, you may also be with a company who writes under another insurance name, because every insurance company I've ever worked for had no less than 2 insurance companies, and in some cases 6 insurance companies, because we would have maybe one that specialized in excess and surplus, and those are like the uninsurable people. So what we would do in that case is we would go one by one and try to find reinsurance to help us cover that particular claim, or you would have to add surcharges because they weren't a good risk. So you don't have to know a lot about that, but we would have an excess and surplus company. We would have maybe a property and casualty company. We'd have a life company. We would have a company for a region, so we would have different companies for different reasons, even based on the domicile. Like some companies like to domicile in Delaware. When I was in the healthcare industry, we domiciled in the Cayman Islands. And what they did is they took the lower level of the insurance that was self-insured by the healthcare system, and it went to an offshore captive in the Cayman Islands, and then all the reinsurers were local. But there's also reinsurance that I've seen in my career where you go to the Lloyd's of London, and it's very interesting, and I don't want to confuse you all with it. But basically, the only thing for you, Lisa, is that the top piece of paper might have a different company name. But the caution with that is you may also have a company like I had to get errors and omissions insurance as an insurance agent. That's a requirement, and that's actually smart to make sure you have errors and omissions. And I wrote my policy under Berkshire Hathaway, but the actual company that wrote it is called like Versus, Bersys. But in looking it up, I could see it's under the conglomerate of Berkshire Hathaway Insurance Company. It's just called a different name. So the only thing that you would ever see is that the name would be different. If you have any questions, or if I've covered something too quickly and you want me to dig into detail on another one of these calls, let me know, because I have 2 more weeks, and I'm sure if I ask, they'll probably let me do a couple more, as long as they're being received well. I do want to share what I know on this side of it, because I believe in the safety of insurance companies. I believe in the IBC to a level I never dreamed possible the first time I looked at it. And I truly believe that this is something that could help so many more people than what we're able to reach now. And if I can anyway help you or help someone else, please reach out to me, because I wish I'd known this sooner. And if we can help more people, maybe we can help people to take back control so that they can bring creativity to light and make the changes that can make this world better. So thank you guys for being here. I appreciate you more than you'll ever know. And please feel free to reach out to me if there's anything I can do for you. Have a great day, and I'll see you next week.
Money. School TV.